I wanted to just talk a little bit about what we're gonna go through the mechanics of making a little what we call pro formas, right? And so, like we talked about last week, the thing is, there's retrospective, which is accounting and all that, and then there's prospective, which is finance. And that's what we're going to be doing, is prospective kind of work, where we're going to be coming up with, and the way that we'll do this is as an income statement. And that's why they call them pro formas. They're in the form of a financial statement, as an income statement. And the three things that come with a income statement, right, are revenues minus expenses equals net income. So that's what we're looking at. And when we're talking about a project like what you guys are doing, there's another aspect to this. There's basically three aspects, right? We're going to model our revenues, and we're going to model our expenses, and that'll give us our net income, right? Because it's the difference between the two. And then there's one more thing we have to model, and that is our costs. So we're going to come up with something that's probably going to look like, say, now we're going to call year 0. And then 1, 2, 3, and we can go out further, but just something like that, right? And year 0 is probably going to be, a lot of it's going to be taken up with costs, right? Where we're developing our project. And we may be lucky enough to have some revenues while we're having costs, so that's great. But we're going to have, a lot of you are going to have your development costs in this year, right? So let's just call that DC, development costs. And then you're going to start to transition into revenue, expenses, and net income, right? Into some sort of operations, right? So you're going from a development to ops, pretty much, kind of thing, right? That's going to be the overall scheme of things. And as we're looking at that, let's say once we get past our costs, just graphically, right, we're going to say, okay, here's basically our cost part here, right? This will be year 0, and here's year 1, 2, 3, 4, like that. And so in this year, we're getting all ready, and we're doing all this stuff, and this is just cost money, right? And then we start to have operations. And our operations are going to be, we're going to have some fixed costs, right? And what would fixed costs be like? Fixed costs would be, unless you make them variable, like you rent a time on a canning machine. If you buy a canning machine, that's a fixed cost. If you have a tap room, that would be a fixed cost, right? It doesn't matter if one person comes in or 1 million people come in, you're going to have those costs each month. So what are some fixed costs? Well, your costs are pretty much all variable costs, right? You get a customer, and then you buy the materials, you do the clipping and trimming and all just for that, and deliver them to the thing. But each of those costs are variable. Unless you were a grower or something, I can't think of you having much fixed costs. Maybe your clippers and vases, that kind of stuff. You have some fixed costs, but very little. And that's, you start thinking about your cost structure, right? How much fixed cost relative to how much variable cost? Like a pizzeria or something, right? You got to get the pizza ovens, you got to get the storefront, whatever. Even if nobody buys a pizza, you're carrying that cost. That's a fixed cost. And so then there's the other component of costs is the variable costs, right? And the variable costs are what goes into each actual item. So you look at the, and you could have fixed costs too that might be somebody that runs an office, some administrative folks, or secretaries, advertising, those kind of things might be. Now with online sites, the fixed costs are also really small too. So that's another way to encourage to stay online, right? And you could even do pop-up tap rooms or something, like where you go around and say, and tell everybody, this weekend we're going to be at Balloon Fiesta, and this weekend we're going to be at this, and not have a rent that you're carrying that's dragging down, especially at first. Try to keep all your costs variable, limit your fixed costs, and fixed costs could be cheap, like just a domain name. If a Facebook page is free, think about what are all the free things and exploit those ahead of time. A Twitter account is free. MailChimp is a great way to build up a mailing list for free, up to 2,000. You can have 2,000 people on your MailChimp list, and it's all completely free. So think about those kind of things. What you can do to manage your fixed costs or eliminate fixed costs, and just have variable costs, and try to get customer interactions and try to see what people like about the stuff, how they're using it, why they're using it. There's a great book called Talking to Humans. You can download it. It's free if you just put into Google Talking to Humans. And it's a book on customer discovery and how do you talk to customers about your value proposition and get good feedback from them, feedback that then you can aggregate up into some statistics and some meaningful information about what you're doing right and wrong. And they call that qualitative research, because it's not quantitative necessarily, it's qualitative. You're asking, what do you think about this and that? And they're giving you qualitative, subjective answers, but you want to have the subjectivity in a way that you can actually use it for information. So it's a great book, and again, it's free, so no fixed costs, right? And the guys who wrote it are really smart, and it's really fun too. So you have these costs, right? And what's the other component? So now we broke these costs into those two things, right? Two components, fixed costs and variable costs. Now revenues, right? That's the other component. How do they fit into this kind of picture, right? Well, revenues start at zero, right? This axis is money, this axis is time, right? So it starts at zero, and then revenues, as you sell units, it could be time, or this could be quantity, how many units you're selling. As you go up, here's your revenues, right? So for each sale, obviously, at the end of the day, you want to sell something, you're pricing it, right? You're thinking about pricing, and that's the key for revenues, right, is pricing. What price you're going to sell, and then quantity, how many are you going to sell, right? And what is revenue but price times quantity, right? How many you sell at what price? And that gives you your revenue. So you'll be driving those in your spreadsheet, and you're making estimates about that. So you're going to have to make some decisions about what you think your costs are and what you think your revenues are going to be, and pricing. And so, and you want to sell things for more than it costs you to make them, obviously. Certainly more than the variable costs, right? A lot of times we break these income statements up and we'll say, well, here's our revenues, and then we're going to break our costs into, sometimes it's the variable costs, it's almost like variable costs, but we call it something else. We call it COGS. You ever hear that word? Cost of goods sold, right? That's the variable cost per se, right? They're pretty much the same thing. There's some differences, but so COGS is how much goes into the cost of each actual good, right? And so if you take revenues and you take the cost of goods sold away from it, then you have your operating earnings or operating profit or something. And then you take the fixed costs, or sometimes they call it, sales, general and administrative, stuff like that. You'll see line items SG&A, but it's really the fixed costs. And then you reduce the fixed costs out, and then you get your net income. And then this gives you two ways to look at, are you at least covering these guys, right? And then you have some kind of contribution margin, is what the cost accountants call it, that's going towards covering your fixed costs. Sooner or later, and then you want to think about, well, if my contribution margin is X and my fixed costs are 100X, then I have to sell 100 units to cover my fixed costs. And then you start thinking about how you're covering this part of your monthly nut or whatever. So now we have these dynamics on a little graph, right? So I'm going to ask you about a couple of points. What is this point here called? Break even. Boom. That's the break even point. That's where your revenues are covering your costs. And so you want to see, where do you get to break even? And really if you can start talking dynamically about your costs in this way, even if they're just sketched out for next week, you can talk meaningful to people, and they'll think that you're an operator. I have to sell X amount of units to break even. And I've done that because I know what my fixed costs are. I got them here detailed on a spreadsheet. I know what my variable costs are. I got them detailed on a spreadsheet. This is my pricing going to be, and so that's where we're going to cross that line. And then, so then what's this part called?
Profit.
Profit. Bingo. Make sense? And that's where you want to get, right? You want to be on this side of the break even. And how long does it take you to get there? Right? How long does it take to get there, say in a year, right? If we're talking about a year. Black Friday, right? It's coming up. In fact, Amazon started their early Black Friday November 1st because they're just like relentless, you know. They're not waiting until the day after Thanksgiving or something. They're doing it now and just crushing everybody, right? Poor Sears, poor JCPenney's.
Sears doesn't exist anymore.
The what?
Sears doesn't even exist anymore.
Right, they went bankrupt. They still exist, but not that they're holding on. And if none of these companies can afford a bad 2018, they're just going to be, and that's probably what's going to happen. So, short Sears, long Amazon, right? If you're an investor. Black Friday, what does the term mean?
When you get into the black.
It does, yeah. It's not like Black Friday. It sounds like some kind of dark day, like, you know, like Black Monday. You know, in the stock, Black Monday was the disaster when the stock market crashed and all. Black Friday, what does it mean? Yeah, you know, some kind of sinister satanic thing or something, right? No, that's what it means. That's when retail firms traditionally go from operating in the red, which means operating over here, to operating over here. And that just tells you how skinny their margins are, right? And how risky that business is. They don't cross this break-even threshold into the promised land until the day after Thanksgiving. And then they have like 4 weeks to scramble to squeak out some kind of profit here. Hardly sounds like a good business model to me, right? And it's not. It's incredibly skinny margins. You know, think about that Kmart over on Carlisle. It's closed now, right? How could that even exist? Because you have to fill up that giant parking lot. There's nobody ever there. All that inventory in that giant store, and people come in maybe buy one or two things. You know, how do they make money? It just doesn't make sense. So, retail is really having, you know, challenges now, trying to rethink what they're doing. There's lots of, you know, little artisanal, just like artisanal breweries and coffee shops and kombucha and stuff like that, and what you're doing, Flores, that are capturing small niche markets, and people like to buy local and have interactions. But there's, on the other side, these just like megaliths that are just online that don't have the fixed costs of inventory and bricks and mortar stores and all that, and then they can take those savings and pass it on to everybody else, right? Pass it on to their customers. And you can't compete if you have to cover these kind of costs and the other guy doesn't have these costs. So I think we got a pretty good idea dynamically about the structure of how this kind of stuff works, right?
MBA ASAP. MBA ASAP.